Hello and welcome. I'm Suyash Maheshwari and you are watching Last Stick here on News9, where we bring to you the lowdown of the day's action on the Lal streak. Now, Indian markets snapped their 5-day gaining streak to end with minor losses on January 16th. Both Sensex and Nifty opened with minor cuts but went on to scale record highs in the morning trade itself. However, from there on, the indices came under selling pressure and trended lower for the majority of the session. At one point, Nifty even fell below the 22,000 mark, but we saw a swift recovery from there on, and we were back above the 22,000 mark in no time. Ultimately, the index managed to settle there as well. At close, Nifty was down 0.29% at 22,032 mark, whereas Sensex settled about 193 points lower, above the 73,000 mark. Remember, at the start of the session, we had indicated that the headliners were in overbought territories, as was indicated by the technical experts as well as technical indicators such as RSI, which indicated that we were moving towards a 70 zone, which is considered a overbought territory. So hence a minor pullback was likely, and that is exactly what happened in today's trade. Now moving on to the broader markets, they underperformed the headliners today. The mid cap 100 index, which by the way scaled 48,000 for the very first time, saw some profit booking at higher levels and ultimately settled at around 47,643 mark, down about 0.41%, snapping its 5-day winning run. The small cap index, which also came within the touching distance of a record high, close about 0.44% lower at 15,541 mark, ending its 3-day gaining run. Now, the correction today also led to an ease in volatility. As you can see on your screen, India VIX for Tuesday's session settled about 1.8% lower, around the 13.5 mark. Now, at the start of the day, we were hovering around that 14 sort of levels. In fact, we managed to cross that levels in intraday trade. So, a ease in volatility is good to see, and along with some bit of a decline or some bit of a pullback in the markets itself. But to make more sense of Tuesday's price action, let's also bring on board Mr. Amar Deo Singh, Senior Vice President at Angel One. Sir, what do you make of today's trade? Is it the pullback that the market was hoping for, or is there more to this correction than met the eye?
Yeah, I would say that if you look at the markets on the short-term basis, they do display some sort of consolidation. And also, if you look at some of the technical indicators, so they point that there is some consolidation. But if you look at the overall trend, there is no change of trend, even on a short-term charts, as well as the intermediate long-term, the trend and the momentum is there. Also, what we are seeing is that across the board, we are seeing different sectors performing. We've seen the IT stocks moving. We've seen Reliance, a major Nifty heavyweight, performing recently. HDFC has also rallied. But if you look at the weightage and component wise, so HDFC really has a significant weightage, almost 13%. So in the Nifty. Now, it has a major zone of resistance coming around the 1700 mark. So that's the level to watch out for on HDFC. For if HDFC is to rally, then it has to trade and sustain above the 1700 mark. On the downside, 1600, 1570, 1600, that's a zone of support. And if you look at the broad base rally that is there today, we've seen more declines vis-a-vis advance, but that also is I would say, natural phenomena. India VIX is also significantly lower, so that is in the concern. Global cues are also positive. But yes, the daily charts are showing some signs of consolidation, and also there's something called bearish divergence on the charts. So that is something which is there. So that's what is leading to some profit booking in the markets. And also the markets are actually, this is the earnings season, so markets are also waiting for the earnings actual results come out, because the expectations are there, but the actuals, how they compare vis-a-vis the actuals, that's something that the markets are definitely looking at. So that's one of the triggers that's actually driving the markets. But at the same time, I would say that we are also likely to witness profit booking at higher levels.
All right, and sir, as you rightly pointed out, January is typically a negative month for our markets. In fact, there is no single January where the market has given positive returns after a strong December, like we saw this time around as well. However, so far it's going well for us. Like, we are at record levels, isn't it?
Yeah, see, markets have definitely rewarded those who had the, I would say, insight and the courage to enter the markets at different levels, be it pharma, be it auto, be it reality, be it financials. So across the board, different sectors. And the best part is that across sectors, we've seen pockets of opportunities which have been there. And if you look at the PSU stocks, power stocks, PSU stocks, railway stocks, all these have delivered superior returns. So there is bound to be some sort of profit booking also, because most important thing that we need to remember is that the smart money, when they really put in a large chunk, so they would definitely look at the risk reward ratio. They also have a holding period, so it's more from at least a couple of years at least. So they look at the risk reward ratio as well as to how that's likely to play out. I would say there would be some sort of caution, and but any correction would be bought into till the time we don't see a trend change. That's very evident in most of the heavyweight stocks as well as the indices as to speak.
And talking about heavyweight stocks, and you also mentioned Nifty Bank. Now that has been struggling to stay above the 48,000 mark for the past 1 month or so. And even today, you know, at the day's low, we did manage to defend that and take support from there on. But you know, broadly speaking, we have made substantial moves above 48,000, but then again we have seen about 800 to 1,000 point correction from there on. But this time around, Amar, do you think that the banking sector on the whole is out of the woods?
I would say if I look at the banking sector, particularly two major heavyweights, HDFC Bank and ICICI Bank. So they'll have almost 50% or maybe even more of the bank Nifty weightage. So looking at them, there are only two levels to watch out for. For ICICI, it's 1,050, 1,060. Currently, it's around 1,010 or so. So that's a level to watch out for. If a major rally has to happen, then ICICI Bank needs to sustain above the 1,050, 1,060 levels. And as I said, HDFC would have to sustain over the 1,700 levels. So these are the levels to watch out for. What we are witnessing in these heavyweights is that the intermediate term trend is very strong. The long term trend is more or less, I would say, positive bias, but it's not very strong. If you look at other different sectors, if you talk about reality stocks and all that, and in specific stocks, you see a very strong trend on the long term charts. That's missing both in HDFC as well as in ICICI Bank. So that's the reason we are seeing this sort of consolidation, and these stocks are unable to decide on a direction. But as I said, the trend still remains positive for ICICI Bank. The downside is around 980,000, 980, 970, 980. That's an immediate zone of support from where the stock bounces back. So it's this range that needs to be watched out for. As far as Bank Nifty is concerned, it's yet to reach its all-time high, as Nifty has already done that on the back of the strong performance of the IT stocks. So Bank Nifty would be, I would say, waiting for these stocks, how they actually perform.
And you know, as we are talking, the numbers for HDFC Bank have also started trickling in. You know, net interest income that came in at around 28,471 crore for the December quarter, which is about a 4% quarter-on-quarter jump compared to Q2, where it stood at about 27,385 crore. Net profit, now that has jumped somewhere around 2.4% as well. You know, the figure comes in at around 16,372 crore for the year ago, for the December quarter, versus about 15,976 crore for the September quarter. Now the numbers, Amar, they are largely ahead of the street expectations. You know, the profit figure was expected to decline on a sequential basis. I think net interest income figure has also surpassed street expectations. You know, just looking at the numbers, just the initial print, do you think, at least as per what your forecasts were, the numbers are better?
Yeah, so in case we see some further clarity here, so in that case, we could witness some upside. But as I said, 1700 levels, that's a immediate 17 to 1750. That's a zone of resistance for HDFC Bank because if we go back in time, and we see that earlier in July, first week of July, it had made a high of 1757. Prior to that, in May, it had made a high of 1754, 1734. So 1700, 1750, that's a strong zone of resistance. But as I had said that the intermediate term trend is positive, strong. Long-term trend is with a positive bias. So we'll have to watch out how the stock really plays out because it has to sustain over the 1750 for any major rally. Otherwise, it could be in for consolidation between, I would say, 1600 and 1750.
All right, and you know, when I was reading about, you know, what the expectations were, there were some concerns about the, you know, the net interest margin, the NIMs. However, it seems that you know, they are stable on a quarter-on-quarter basis. Given that we also saw a strong loan growth, you know, in the Q3 business update of HDFC Bank. So, you know, from a business standpoint, and after the merger, is the worst for the bank now over?
I would say, given the numbers, it appears to be so, but we'll have to actually because HDFC and HDFC Bank coming together was of, I would say, gigantic proportions. So to really get into the synergistic value and develop that, I would say, desired outcome, that would take time. So we'll have to at least give a couple of more quarters to actually see how that really works to the
Right.
advantage of the HDFC Bank. But yeah, the numbers overall are positive.
All right, moving on from HDFC Bank, you know, tech stocks, now they were the flavor of the past few sessions, but they saw some bit of a correction today. In fact, Nifty IT on the whole was one of the worst performers, falling over 1% in Tuesday's trade. What do you think are the factors that led to this sort of a correction? Just some good old profit booking, or do you think that the market jumped the gun in anticipating a turnaround in demand?
See, if you look at the Nifty IT index, Nifty IT index overall the trend was up. There's no doubt about it. So the markets were expecting that the worst definitely is over, and if there is something, so if we got the I would say major results of TCS and Infosys, which was not I would say wasn't very positive, but markets took it that okay, it's better than something worse. So from that perspective, the stocks again, both TCS and Infosys, and if you see the sort of rally which these stocks have given, and apart from that, some of the other stocks, that is bound to bring in some sort of I would say consolidation, some sort of profit booking. Because if I go back and look at Nifty IT in particular, so if we look at Nifty IT made a high of almost 38,000 levels, and then again it has corrected today, but that's okay. I would say shouldn't read much into it. It's more of profit booking. We'll have to see how the other IT stocks as well perform.
All right, that's a view coming in from Amardev Singh, sir. Always a pleasure speaking to you. Thank you for giving us time, and thank you for joining us here on News9. Thank you.
Thank you.
But with that, it's a wrap on this edition of Last Tick. Keep watching News9 as we'll be back with Business Plus on the other side.
Ram's Ayodhya rebuilt. Ram Lala's Pran Pratishtha.